Hello and welcome back to Interpreting India. As the world looks to emerge from the shadow of the coronavirus pandemic, 2022 so far has been defined by precarious geopolitical relations, drastically shifting economic trends, and rapidly evolving technological landscape. This season, we at Carnegie India are examining many of the challenges and opportunities that India will confront in the coming decade. I'm your host, Suyash Rai. In this episode of Interpreting India, we analyze why India and other major economies are experiencing high inflation, the measures that have been taken to control inflation, the expected impact of these measures on economic growth and other developmental indicators, and the future course of action. Joining us today for this discussion is Radhika Pandey. Radhika is a senior fellow at National Institute of Public Finance and Policy. Her academic work focuses on macroeconomics, business cycles, financial policy, and regulation. She's been a part of a number of Ministry of Finance instituted committees and writes regularly on contemporary economic issues. Hello, Radhika. Welcome to Interpreting India.
Thank you, Suyash. Thank you for having me.
So perhaps we could begin by taking stock of the global picture. What is the inflationary landscape right now? And as people have been writing that in the advanced developed economies, inflation has been at the highest in more than 3 decades. And even in the emerging and developing economies, it's been highest in more than a decade. So if you can just help us understand what the current global inflationary landscape looks like globally, and how did we come here? What are the main drivers of this situation that we are in?
Sure. So, see, the obvious driver has been the Russia-Ukraine war. But if we just step back a bit and we look at the pandemic time, the inflationary pressure started building up during that time. So, during the pandemic, we had these supply side disruptions. And even before that, for some items, like for some of the items which are used in the automobile sector, the chips, we were seeing some kind of shortages there and some kind of supply side disruptions, and input cost pressures were building in some sectors. And then the war aggravated. So during the pandemic, we had supply side disruption, and then the war further aggravated the supply side disruptions, which resulted in the spike in prices. What is equally important to note is that the nature of inflation in advanced economies is a mix of both demand side and supply side, because when we see what kind of policy response was initiated by the governments in advanced economies, they initiated huge fiscal packages. They gave money, what is termed as helicopter money. They gave money in the hands of people to mitigate the pain of the pandemic. So at that time, when the supply side was weak, the supply side was tight. At that time, when demand was increased, we saw more, the aggravation of inflationary pressures, and we saw a pent-up demand taking shape when the economy started opening up. So when we saw some slide in the COVID cases, while supply side disruptions take time to ease, the demand pressure started rising, and that resulted in increase in prices. So that was the condition during the pandemic, which was further accentuated by the war, which further created supply side tightness, particularly in commodities like crude oil, metals, fertilizers, and so on. So that's the point on key drivers. And if we talk about the inflationary landscape, as you rightly pointed out, in economies like US and UK, inflation has touched record highs. Inflation has risen to 8.6% when the target is around 2%. The inflation target is 2%. So inflation has been rising, and it's now become entrenched. It started with a few items. It started with, interestingly, started with things like used cars, and now it has become more broad based. It is now not only limited to goods; it's spilled over to services, and therefore we see aggressive policy rate hikes by the central banks.
Right. Now, coming to India, you said that the target inflation rate in most of the developed countries is a 2%. Our target rate is 4% with a tolerance band of 2 to 6%, right? And now for about 5 months, the inflation has been higher than 6%. And I mean, even though there was a slight moderation from April to May, there was a slight decline, and but still it was about 7% in May as well. So the situation is still of high inflation, I would say. What are some of the reasons that are India specific for inflation in India, and also what extent do you think the inflation has been imported because there's a global inflationary kind of pressure building up, and India cannot remain untouched from that. So, what are the factors that are India specific, and what are global factors driving inflation in India?
So again, going back to the pandemic time, now we see inflation rising above 6%. But even from the second half of 2021, we saw inflation rising, and inflation was inching up towards 6%. And during that time, it was primarily due to the pandemic and due to the pandemic-induced disruption, the supply side shortages primarily. Now, what is happening is that, again, due to war, there are supply side disruptions. But at the same time, because the COVID cases have receded and economy is opening up, so we are seeing a revival in demand. In some indicators, we can see that, through some indicators, we can see that demand is reviving. So while, again, the same kind of a policy picture where demand has started to pick up, whereas supply side disruptions still persist. So that is the reason for inflation. But there are, again, the bulk of the inflation problem is due to external headwinds, but there are domestic factors as well. There are these extreme weather conditions that have resulted in increase in prices of cereals, particularly wheat. We saw a shortage in the wheat production. Whatever was estimated, projected in the advance estimates, we did not reach that target. As a result, India had to announce export ban on wheat because of this reason to improve the supply of wheat. So while primarily it has been driven by international factors, but now what's happening, it started with international factors, but now due to demand also picking up, we are seeing that the inflation has become more broad-based. We are seeing not only in goods, but also in services. The inflation is picking up because, in sectors, the contact intensive sectors, which were earlier showing a muted growth, are now showing revival. So people are increasing demand, people are stepping out. So we are seeing increase in demand there. So supply side disruptions coupled with revival of demand alongside extreme weather conditions, these are some of the factors that have contributed to now a broad-based inflation in India.
Now, obviously, the policymakers have to respond to the situation, and they are taking steps. So, on April 8th, the RBI's Monetary Policy Committee decided to keep the repo rate unchanged. But on May 4th, they decided to raise the rate by about 40 basis points to about 4.4%. And then again on 8th June, they decided to raise the rate to 4.9%. The CRR was also raised by about 50 basis points to about 4.5%. So, do you think the RBI has acted in a timely manner, and is this response adequate? So, there are two parts to this question: whether the RBI should have acted earlier, on hindsight, of course, and whether this response is adequate for the kind of situation that we're in.
So, coming to the first question, which is on whether this could have been done earlier or not, whatever aggressive now policy tightening that we are seeing. So, to that question, I would say that the de facto tightening of monetary policy started from the second half of 2021, where we saw Reserve Bank doing more of absorption of liquidity. While we did not see interest rate hike, but de facto policy tightening started in from the end of alongside towards the end of last year, calendar year last year, where they started doing more of what is termed as variable rate reverse repo auctions, which are used to withdraw liquidity. So that is one thing, that is one manifestation of a reversal of their ultra accommodative monetary policy. The other part is that they did not extend what is termed as the GSAP, the Government Securities Acquisition Program, where they were buying government bonds and infusing liquidity. So that was another instrument of accommodative monetary policy, which they discontinued. So they gradually did start with policy tightening, but the real change happened from the April policy. And if you look at their guidance, the monetary policy statement that is announced alongside their resolution, it said that there for the first time they mentioned withdrawal of accommodation. Till then, the priority was on growth. But from April, they started talking about withdrawal of accommodation. And then in May, they came up with this surprise policy hike at the same time when the US Fed had to hike the interest rate. So we are seeing that the Reserve Bank is responding, but again, the situation has been so uncertain. So I think it will be unfair to say that Reserve Bank was behind the curve, because at that time the priority, the heavy lifting on for supporting growth was done by Reserve Bank of India. The government's policy response was, again supply side oriented and again focused on credit, which was the mandate of the Reserve Bank. So Reserve Bank did much of the task of supporting growth and mitigating the distress caused by the pandemic, and we do see some of the positive impact of that. And from October onwards, they did start with withdrawal of accommodation. And again, here it's important to understand that the nature of inflation in advanced economies and India was different, primarily because of the policy response that advanced economies government, primarily the US, adopted and what India adopted. We did not have a fiscal package kind of a support, which the US did. And therefore, their inflation was more of demand led, which could be addressed by interest rate hikes at that time. So they started giving this communication that, now we are going to start raising rates. They started, changing their guidance. They started giving forward guidance on the fact that now is the time to, shift focus from growth to inflation. Whereas India continued to focus, RBI continued to focus on growth till say January, February. The focus was on growth, and then from April onwards it shifted. While some kind of de facto withdrawal started happening from October itself. So I think it was a fair assessment, because nobody could have anticipated the war and the steep supply side tightness that have arisen due to the war. So I think during that time and given the conditions, I think it's unfair to say that RBI fell behind the curve. Now what it's doing is raising the rates, and that is the only blunt policy instrument in the hands of the Reserve Bank to address inflation, which it is doing. And based on the trajectory of how inflation moved, they have themselves given this projection that, till the end of this year, inflation would not be below 6%. So to control that, they would have to raise rates, and raise rates in such a way that at least the real rate turns marginally positive, to give some kind of incentive to savers. Otherwise, if we keep having negative real returns, then whatever, the deposit mobilization will not happen, and whatever credit growth we are seeing, that will not be sustainable, that will not be supported. So now the role of monetary policy at this point of time is to effectively anchor inflationary expectations in a way that to come up with rate hikes in a way that, the real rate turns at least marginally positive.
You made a comment on fiscal policy as well. So I want to go down that tangent a little bit before we come back to this. That I remember back in 2020, there was a big chorus to demanding big fiscal support and basically increasing deficit even further beyond what was increased to be able to support demand in the economy. Now, if I'm reading you right, you seem to be saying that if we had done that, if the government had done that, today we would have been a much more difficult situation, not just fiscally, but also in terms of inflation, which seems to be the major driver in many of the developed countries. So now, obviously, we have, because of not embarking upon that kind of a strategy, we have saved up a little bit of fiscal space. And what can the government do? So RBI is doing what it is doing in terms of monetary policy actions, but what can the government do to help in this inflation fight? So if to be able to stem it basically, because if you look at compare India's inflation to the inflation in developed countries, we are not doing too badly because our tolerance band is also very different from their tolerance band. So we are not way above that, while they are in a very different zone, especially countries like US are a completely different zone. But we need to be careful, and we need to ensure that it doesn't get out of hand. Is there anything that fiscal policy can do in this regard?
So, government has already taken some steps on fiscal front, like we saw that excise duty cuts were announced on petrol and diesel, and on subsidies, on fertilizers, the subsidies was enhanced from what was given in the budget. So again, from fiscal side, the government can continue to do these things. It has been doing, like on edible oils, it had slashed the import duties at the time when Indonesia had banned the import of palm oil and so on. So on edible oils, on subsidies, on crude oil, they have reduced duties and increased subsidies. But again, there is a trade-off. How much duty cuts can be made, because if your fiscal deficit gets too much deviated from what you had targeted, and then you are going to borrow more, that will lead to increase in interest rates, and it has its own set of implications which are very adverse to for the revival of an economy like India. Because if your interest rates start rising, then again the poor would be more adversely affected, because investments will not happen, job creation will not happen. So that kind of a balancing act between acting to tame inflation, to take steps from the fiscal front. So these are the steps, the steps that the duty cuts and increase in subsidies to cushion the impact of the global surge in prices. But again, there are complex trade-offs that every government faces as to how much duty cuts to give so that fiscal deficit does not deviate too much from the target, because it then has an impact on private investment. It leads to crowding out of private investment.
Now, coming back to the inflation and monetary policy action against inflation. So, obviously, the rate hike is quite recent, a couple of months back. It happened again a month ago. So, what are some of the early signs you're seeing in terms of transmission of the monetary policy? Is it already happening, or is there? Usually what is said in India is that there's a big lag between monetary policy decisions and their actual transmission into the economy. So what are the signs that you're seeing as of now?
So one sign is that the interest rates have started to rise. The lending rates. If you look at the monetary policy transmission towards the lending rates, that has been very fast, because now most of the banks follow an external benchmark to price their loans. So that has already started happening. While on the deposit side also, some of the banks have raised their interest rates, but not to that level. And that is understandable because deposit rates are sticky. But we should see going forward some hike in deposit rates. So that is one element of transmission that we are seeing, that interest rate hikes leading to increase in lending rate. What we also need to see going forward is, the Reserve Bank of India's inflation expectation surveys that are released. So how will they be impacted? Because the lending rate and deposit is one element, but what is important to see is that whether, due to these rate hikes, the inflation expectations are getting anchored or not. The 1 year, 3 year, near-term inflation expectations are getting anchored or not. So that will be the real test and the real challenge. And I think for that purpose, it is needed to have more certainty and predictability and better communication and forward guidance that we will continue to raise rates till inflation is brought under control, so that inflationary expectations are anchored. Otherwise, there will be a kind of a wage price spiral, because then consumers, because inflationary expectations are backward looking, they will demand higher wages. Companies will also start curbing their investment plans, thinking that inflation is unanchored. So it will have all sorts of adverse implications on the economy. So what we need to see is that going forward, what happens to inflation expectations, because once those are there, we see signs of moderation, we should see the improvement. In one of our recent works that we did on inflation targeting, the efficacy of inflation targeting over the last 5 years, it was a study conducted last year. There we did see that, post the introduction of the inflation targeting regime, the inflation expectations were better anchored. So, if that is the case, if that continues, we should see a moderation in inflation. But again, if the global headwinds continue to remain elevated, inflation remains elevated, the task of Reserve Bank will become complex, because then there are growth implications also, as what we are seeing in the US. There's a talk of recession gaining salience.
I want to move a little bit towards the global scenario back again. And we are seeing that much of the developed world, especially US, Europe, they are waging a war against inflation. They're taking serious actions. And these are economies with which our economy is also integrated in many ways. Investment flows, trade flows are quite significant, and other connections as well. So, what the two-part question? One is that what would you describe the overall and inflation strategy in these countries, and how do you see that affecting Indian economy? What are the pathways that through which it can affect Indian economic performance in the coming year or so?
Sure. As we discussed, the main strategy which the advanced economies have been adopting is the rate hikes. And since the US has been pursuing aggressive rate hike, they started with a 25 basis hike, then they did 50 basis hike, then they did a 75 basis hike. So what we are seeing is that the yields on the US denominated bond is rising. Now, whenever if we want to study the trajectory of foreign investors movement, whether there will be an inflow towards India or other emerging economies, or outflows, a very important variable to look at is what is the differential between what an Indian bond is offering and what a US bond is offering of a similar maturity. So, what a 10-year Indian bond is offering and what a 10-year US bond is offering. If that difference is wide, if the Indian bond is offering much higher return than a US bond, then there will be inflows into India, into emerging economy. And that is what we were seeing during the pandemic time, because the advanced economies had a very ultra accommodative policies. They were infusing liquidity, they were expanding their balance sheets. So we were seeing the differential between Indian bond return and the US bond return widening, and which led to greater inflows into India. Now, the reverse of that phenomenon is happening. What we are seeing is that while the Indian bond yields are also rising because of inflation concern, but the US bond yield, the pace of increase in the US bond yield is much more than the Indian bond yield, and therefore the differential is narrowing. And when the differential narrows, given that US is a safe haven currency, it has the status of reserve, international reserve. Therefore, we see an outflow from India and other emerging economies to back to the US. So, due to the aggressive rate hikes which the advanced economies have been following, we are also seeing outflows, a consistent outflow. Since the beginning of this year, we have seen more than 2 lakh crore of outflows already happening, and this is still continuing. So, that is one implication. The other implication of this on the Indian market is that because the situation is highly uncertain, the risk appetite of investors has reduced considerably, and again there is a tendency to keep focused only on safe haven assets, and therefore again the demand for dollar denominated assets has increased. And that is what again we are seeing, that the dollar index, which is the exchange rate of dollar with respect to a basket of currencies, it has hardened, it has strengthened. So again we are seeing an outflow from India to these economies. So one of the implication of the US Fed following an aggressive monetary policy is consistent outflows from India. Now, why that is a problem is that because traditionally we have a current account deficit because we are an oil importer country, we have a current account deficit. But the good thing is that normally we have a surplus on the capital account. So much of the deficit in the current account that we see, which is the deficit due to trade in goods and services, because our imports are more than exports, that deficit is somewhat bridged by the inflows of foreign investment. Now, that part is also not helping because our current account deficit is widening, but on the capital account also we are seeing an outflow. So, because of this, the current account deficit is becoming a more serious problem. So these are the two, implications. And because of the current account deficit becoming a serious problem, we are seeing a, depreciation of the rupee. Because we are an oil importing country, our current account is highly vulnerable. And at the same time, we are seeing a sustained outflows of capital from our country. So as a result, we are seeing a consistent rupee depreciation. And that is not just a phenomenon for India, it's a phenomenon for all countries which are commodity importers, all countries which are dependent on imports of oil or energy or fertilizers. We are seeing this kind of a phenomenon.
Right. Also, because I mean, the effect of many of these anti-inflation, policy actions is basically to depress the demand in these countries. Do you think that there could also be a pathway through trade? Because we do export big to these countries, especially our services export, but also goods exports go to many of these countries. So, that may also may be affecting our current account deficit through trade deficit route as well. But what is your kind of view on this?
Yeah, so we spoke about inflation affecting the global inflation and policy response and towards inflation, how it is affecting Indian economy. Now, because of this aggressive rate hikes in the US, now people are talking about growth getting depressed and therefore some signs of recession happening in the US economy and even in the EU region. So because the US GDP has already contracted in one quarter, in Jan to March quarter, and if we see another quarter of contraction, then technically US will be in recession because the technical definition of recession or the textbook definition of a recession is two consecutive quarters of GDP contraction. So that way we are seeing, and there are certain indicators based on previous episodes of recession that can assess whether U.S. economy is headed towards recession. And one of those indicators is the yield curve inversion. So what we are seeing in the US is that the 2-year yield has risen much more than the 10-year yield. Normally what happens is your yield curve is steeper. If your 2-year bond will offer you lesser as compared to 10-year because you are parking your fund in a 10-year bond for a greater period than for a 2-year bond. But if the reverse is happening, where the 2-year bond is offering a higher than a 10-year bond return, then it is a sign of recession. And whenever in the US we have seen this kind of yield curve reversal happening, or inversion of yield curve, we saw recession. So it's a kind of a leading indicator for recession in the US. So due to these reasons, we can infer that there could be some elements of recession or maybe a mild recession in the US in this year. Now, if that happens, as you rightly pointed out, Indian economy is integrated. We may say that we have capital controls and we have these restrictions. So, but de facto, India is integrated with the global economy, and we are seeing those headwinds. So that will have an impact on our trade and investment flows further because last year we did record a $400 billion of exports target, and going forward our exports will suffer if there is a recession not only in the US but in the global economy as well. So that is one reason, that is one channel through which recession will have an impact on the Indian economy, and that can lead to recession in India as well, because the other drivers of demand. So we consider consumption, investment, exports. So if exports is doing well, economy can be supported at a time when consumption and investment is still picking up, or it still is not reached a sustainable level. It's still anemic. So in that scenario, if our exports also go down, then there will be weakening tendencies in the economy as well. And that is what we are seeing in some of the World Bank documents that are coming out now as compared to what came out in January or March. They have all downgraded the growth projections, not only for global economy or for US, but for India as well. Though our growth is still more than the other economies, but there has been a downward revision. So these are all implications of stagflation or a recession kind of a situation in the global scenario.
So, I mean, since I'm talking to you, I should bring up the impossible trinity. And so, in macroeconomics, there is this impossible trinity that you choose two out of three, whether you can have free capital flow, fixed exchange rate, independent or sovereign monetary policy. So, as of now, RBI seems to be allowing the rupee to depreciate gradually, right? It is, it's just happening on a regular basis. But in the past, you've seen that RBI is quite sensitive to the rupee's valuation, and there is they do intervene to try to keep it within a certain range that they may have in their mind. It's not clearly publicly stated what they're comfortable with. It's something that they do. So, how do you see the macroeconomic management that RBI does basically? And in some of the policy instruments, government also has a say, changing in the next few months to a year under the current situation where there's a steady rupee depreciation, as of now, high inflation, not just in India, also globally, and capital outflows. I mean, overall happening. There are some short periods in which there's been a net inflow as well, but overall there's a outflow happening. Is there any, I mean, big shift you are seeing you would see in terms of the overall macroeconomic management in the next few months or so?
So, as you rightly said, RBI has been juggling three objectives. RBI is doing exchange rate management and inflation management, and the third objective is that it is the debt manager to the government borrowing. So, it is kind of juggling between these three objectives, and now it's becoming increasingly complicated for RBI to focus on any one objective. So while legally, RBI is supposed to be inflation targeter, but time and again it intervenes in the foreign exchange market to arrest the rupee slide. It has been doing that. It's not that it is not intervening. We can see that in the foreign exchange reserves have plummeted below $600 billion, primarily because of the fact that Reserve Bank has been intervening in the spot market. It has also been intervening in the forwards market also to arrest the rupee slide. But I think there is a limit to how much the Reserve Bank can intervene, because they talk about their forex reserves being in comfortable position. They are able to cover these X months of imports and so on. So if they continue to intervene by buying rupees and selling dollars, that argument they will not be able to make. So beyond a point, there will be some limit to how much they can intervene. But they have now employed the other method. So they have the one way of arresting rupee slide is through intervention, exchange rate management. They are also now doing exchange rate management through capital controls. So, as you see, yesterday the Reserve Bank came up with these measures to augment the flow of foreign exchange into the country. So, that is also one instrument, one lever that they have to, encourage the inflows of capital. So they have liberalized external commercial borrowing. They have liberalized some limits of foreign investment in government debt and corporate bond. So these are all the things they are doing to arrest the rupee slide and to rein in the current account deficit. But what again needs to be seen is whether these steps would, while they are in the right direction, but whether these would be effective to prevent the rupee from sliding further, it needs to be seen. Because while if they would have been taken in normal times, the impact would have been different. But at a time when there are more push factors, causing the dollar to flow out, at a time when dollar bond yields are rising, people would prefer investments in dollar denominated assets. So while these measures would help in boosting sentiment, their impact in the medium term would be seen, but in the immediate term, it won't be too effective. So what we are seeing is that the Reserve Bank of India is managing exchange rate also. It's trying to manage inflation also, and at the same time, it is also trying to manage the government borrowing. Side by side, it keeps coming up with some measures to incentivize banks to invest in government bonds. So it's becoming increasingly complicated, because at a time when interest rates are rising, interest rate on government borrowings will also rise. So the Reserve Bank will have to make a call between whether they want to keep the interest rates low to support government borrowing, or to increase interest rates to manage inflation. So, that is why we have always been talking about having an independent debt management office, and to, take away this responsibility of debt management from RBI. Because in situations like this, the complication becomes, we can see the trade-off very clearly.
Yeah, and also, I mean, there's now more pressure to ease capital controls also. I mean, as to consider it as one of the instruments to ease some of the pressure on the bank, on the Reserve Bank as well. And under these kind of situations, such decisions can be taken, perhaps, and that would not be taken otherwise. Now, I'm just kind of ending on a crystal gazing kind of note. Said again, two parts. One is that how do you see, what is your kind of, there are different scenarios one can paint, but what is your scenario for especially inflation in India? Because the decisions, I mean, there have been monetary policy actions taken, there are some fiscal decisions taken, and there may be more taken. But I mean, going forward, say 6 months from now, do you see inflation coming within the tolerance band in India? And similarly, on the global scale, do you see this as a, I mean, going by your understanding of economic history and how these episodes play out, the war may, end at some point, or at least will become less of a factor, hopefully, over time. Other factors may also change. But do you see this as going beyond, suppose, say, December 2022, or is this something which is likely to last longer? What is your scenario?
So scenario on inflation is that it will remain elevated, and talking about CPI inflation in India, uh, it is likely to remain elevated till the end of the year, because even if the war was to end tomorrow, there will be some time for the stabilization to take place, for supply chains to repair, and so on. So inflation is likely to remain elevated, and even going by RBI's projections, it's not going to be reduced till the end of the year. It will take at least till the end of the year to come to the inflation band of 6%. But my viewpoint is that it will linger on beyond that point. Inflation will remain a problem, uh, not just because of domestic factors, but because of global headwinds, and the fact that now inflation has become more broad based, it has become entrenched, it has shifted to services also. So it's not just one or two factors driving inflation, it's a broad based thing. And even if the global factors start to moderate, like we are seeing metal prices moderating. If you look at the aluminum prices, copper prices, they have fallen from their highs. Even if we look at crude oil, it has started to retreat. But these factors will take some time. So I think towards the first half of the calendar year of next year, we should see some moderation in inflation. But what we also need to worry about at the same time is the what will happen to growth, how the growth will pan out in the coming few quarters. Because if there is high and sustained inflation, it impacts growth, it impacts consumption, it affects the discretionary consumption, employment, and so on. So those things are also to be seen. What we are seeing in other countries about the combination of high inflation and weak growth, how much of that spills over to India, that is also will become more clear over the next couple of months.
If you were on the MPC, would you recommend another hike in the next MPC meeting?
Yes, definitely. Another at least 2 to 3 hikes more, so that the we have the real interest rate turning at least positive, or right now the policy repo rate is 4.9, and inflation is 7% if we go by the last month's print, though to some extent it was driven by base effect, and we should actually see some more months inflations to see to make a statement on whether inflation has started moderating, it has peaked or not. So we should see 2 to 3 more rounds of repo rate hikes. The quantum can vary. It may well be that they front load more rate hikes in the first 2 meetings and then they start to taper off. So that is one thing that needs to be seen. But there would be at least 2 cycles of rate hikes.
Thank you, Radhika. This was very informative and a lot of wisdom of many years of thinking and working on macroeconomic issues. I think in issues of macroeconomics, it takes a lot of time to actually develop good judgment, because you have to see many cycles play out and then you develop a sense of judgment. And I think you've been at it for such a long time that you have that sort of intuition now. And we are very thankful that you could join us today. Thank you.
Thank you, Suyash. Thank you for the very insightful discussion.
We'll be back in 2 weeks with a new episode. To make sure you don't miss, subscribe to Carnegie India on Apple Podcasts, Spotify, Stitcher, or wherever you get your podcast from. To learn more about our research and team, you can visit carnegieindia.org. You can also follow us on Twitter, Facebook, LinkedIn, and Instagram. Thank you for listening. See you next time.